Welcome to Investors Support Network webinar. This is Technical Analysis Demystified webinar. I would like you to ask a question about how technical analysis could help you. And the first thing you need to think, do you want to work for money or make it work for you? Now, if you look at the big picture, investors make their money work for them by two ways. One, they can collect interest or dividends. And the second way they can make it is by stock or any other security price appreciation. Now, let's take an example of well-known companies and try to illustrate how these two ways of making money would work. You could buy a stock or security or bond or any other fixed income instrument that pays you some dividend or interest, obviously. In this market, if you get a few percentage points, that would be a good deal. The second way of making money is to buy a stock or any other security at a certain price and sell it at a higher price, and that's the way you're making money. Now, just to give you the perspective, if you use a fixed income instrument, you probably could expect between actually right now 0 and maybe 3, 4, 5%. If you buy securities such as stocks or options or futures, the overall market can fluctuate between 1 and 5% a week. So whatever you could make in interest and dividends in a year, you could make or lose in 1 week in securities. Specific example that I would like to use is Barricade Gold. It pays 1.2% dividend, and many fund managers use this stock in their portfolio. Now, since August 2014, its stock has dropped by 17%, and actually in the last 2 years it came down more than 60%. But let's just focus in 1 month. The drop of 17% is equivalent to 15 years worth of dividend that you lost in this particular investment. So dividends are important. However, you must also pay attention to stock price movement. And as you can see in the illustration, sometimes markets and economy and your expectations would move in different directions. Now, the question is now, what makes the stock price to move up and down? What are the main areas of influence? And there are many studies that spend significant efforts to answer that question. And the conclusion was that there are 3 factors that influence the stock movement. One is the company fundamentals. And it's very obvious. It depends on the product the company makes. If you look at BlackBerry or Apple, sometimes they come up with excellent product which makes their stock to move up. And then they have some setbacks, like BlackBerry almost out of business today because their product did not catch up with the competitors. You also have to deal with the management. If Steve Jobs passed away, Apple today is not the same company as used to be. And there are many other factors like company balance sheet, revenues, earnings, growth, dividend, etc. So that's the company fundamentals. The second factor that affects the stock movements is sector changes. If a company is certain sectors, like we talk about technology, like BlackBerry and Apple, if it catch on fire or fall out of favor, it moves the stocks. Companies with solid or poor fundamentals alike are pulled along with the rest of the sector. To illustrate that, think about the gold, a commodity sector, and the perfect example is Barricade Gold. It may have good fundamentals, but all the sector related to precious metal, particularly to gold, went down in the last 2 years, and that took together good and bad companies in the same direction, which in this case down. And the third factor that affects the stock movement is the market swings. A rising market pushes stocks prices up, while market correction or crash pulls stock prices down. And there's no better illustration than the dot-com era, where it doesn't matter what fundamentals, anything that had .com behind the company name would rise to the stars. Now, between all these three factors, you can see that the company fundamentals accounts for 20%, sector changes to 30%, and more than 50% actually is the market swings. The conclusion of that is if you want to be on the right side, you probably want to make sure that you follow the market swings or market direction. Now, to analyze all these factors, it's fairly complicated. And probably what we need is more effective tools. Technical analysis is a powerful visual tool which helps investors to analyze stock price movements. But technical analysis is not investors' holy grail or crystal ball. It does not predict future prices or market movement, which is a very basic misconception about technical analysis. Now, let's talk about what determines stock market price movement. Is it logic, meaning that you can analyze, have some calculations and formulas, or it is based on emotions? Investors are human, and it is not surprising that financial markets reflects human psychology and behavior. Irrational exuberance is a phrase used by former Federal Reserve Chairman Alan Greenspan. Technical analysis maintains that all information is already reflected in the stock price. Trends are your friend. The technical analysis does not care what the underlying value of a stock is. Stock prices trend directionally, which means it can go up, down, or sideways. The basic definition of a price trend was originally put forward in Dow Jones theory. Now let's talk about charts, because charts is a very fundamental feature in technical analysis. And it is similar to the charts that you see in any business setting. A chart is simply a graphical representation of a series of prices over a set time frame. For example, a chart might show a stock's price movement over a 1-year period, where each point on the graph represents the closing price for each day that stock is traded. Now, when we look at the charts, the first thing that you need to find out where the market goes. Is it in uptrend? Is it in downtrend? Or it's going sideways? So on your left top corner, you see like a typical movement of stocks up and down. And every time that it comes down to this point, it bounces back, and then it comes down and bounces back, and again. If you connect these lower lows and draw a line, in technical analysis, it is a support level, or you can call it a trend line, meaning stocks are moving along this line. And this is a good market to be invested because it has proven several times, like 1, 2, 3, 4, 5 times, actually 4 times, that it served as a support level. Similarly, you can look at the downtrend market. The prices went up, reached a certain point, and could not continue going up, and they broke down and went down, and did several times, touched these points, and continued dying. So this line is called the resistance level, or a trend line on a downtrend. Now, nothing in life goes forever, and the same the markets. The first example was it was uptrend, but at some point it will break down and will start going down, like at this point. Or when the market went down, at some point it will stop going down and will break up and start the new uptrend. So these are the basic concepts of trends in technical analysis, and it is proven that you would be much better off if you go with the market instead of going against the market. It's like swimming with the stream in a strong moving river, or swimming against the flow. In my personal opinion, I rather swim with the flow rather than trying to go against the flow. Another feature that technical analysts use is patterns. Now, when the price is moving in different directions, they reflect, as we discussed before, behavior of people. And people, or humans, have their own habits. We all have habits. You do certain things in a certain way, and somebody else does in a different way. You react to some events in one way or the other. And in time, we perform the same action based on what input we had. So these are the basically behaviors or habits that we have. It's not different in the marketplace. The marketplace, which is nothing more than just a group of people, a very large group of people, they react to news or other realities in a certain way. So if you would be able to read their basically habits, you would have a big advantage over everybody else to kind of foresee how they would react. And that's what is the pattern trading in technical analysis. And this is a big issue that we probably could have a course on its own, but you probably heard like head and shoulders. This is the price movement patterns, or wedge and up and down breakups, double bottom, double top, etc. And the last feature in technical analysis I would like to show you is a candlestick. It was actually developed in 18th century by a Japanese rice trader. I even don't attempt to pronounce his name. Why is it important? Because if you remember, when we look at the chart, each day was represented by a dot or point on the chart. However, during the day, many things happen. Some news came in and out, and people change their opinion and decided to buy or sell stocks. And therefore, the price of the stock during the day moved up and down, depends on emotions or depends on decisions people and companies made. And if we look at the chart, we cannot see that information because in one dot, all that is lost. The principle of Candlestick is to represent these movements during the day in a special visual effect, which is shown in this illustration. And the candlestick has 4 points instead of 1 that we discussed before. It has the opening price, so this market opened and the stock traded, let's say, at $100. So this is the opening price. And then whether something happened or people decided to sell, and the stock could go down, or it could be the other way, like in your right side here, it opened on this price, let's say $100, and went up to 110, and then 120. So you have the opening price, and you have the lowest price. So the price during the day went to this low point, and then it went up and closed at a certain price. So in Candlestick, you have these 4 points: the opening price, the closed price, the highest point the stock reached, and the lowest points it reached. Now, if you look and pay attention to what happened, you could actually determine who is in control. And in Candlestick, they use actually colors to represent that. So the black candlestick, black like a rectangular that you see here, actually shows that the stock opened at a certain price and it closed at lower price, which means that if you look at the market, the sellers won the war against the buyers. That means that there were more and more powerful sellers than buyers. So that's definitely kind of negative thing. And similarly, here in the right side, where it opened a certain price and closed higher, which means buyers won the war at the end of the game. So it's as a tug of war, and buyers and sellers pull in different direction, and at some point there is someone that actually overcome the force of the other. That's why when you look at chart, and these are like typical candlestick chart, you could, by looking at each candle formation and shape, what direction the market moved during the day, and also has its own patterns, and I just list some of them, like a hammer and etc. And you can determine whether this is a bullish or bearish pattern, which will help you in making the right investment decision. Now, this is just a very basic description of what technical analysis is about. If you want to read more about, there is one of the best book written by John Murphy. It calls Technical Analysis of the Financial Markets. And here are several free websites that you can read more about technical analysis, as well as see the actual charts. I personally use this program, which is TC2000 for Warner Brothers. I used before eSignal, which is equivalent or has certain features that the other program don't have. You may need to have a paid program, or you can use free program. And that's very much concludes my presentation. Any questions? Okay. Now, I would like to show you some actual charts. And the first one, obviously, about Barricade Gold. And you can see from this chart that this is the point back in August, I don't know, 11, probably 14, 15. It was traded at $21, so trading now at 17. So it lost 19%, which, if you remember, equivalent to about 15 years of dividend of that stock. And now we look at the Canadian market, which also traded down recently, just 4%. But if you look at the longer term chart of Canadian market, it did correct a little bit. But as you can see, you don't need to be rocket science to see that it's in uptrend. This is a representation of U.S. market, and I use SPY ETF. And in last month or so, it traded sideways, and then it had the correction in last week or so. It came down about 2%. In my opinion, it's not a big deal. However, there are many gurus on TV came out and started yakking that it's the end of the world. I'm not sure if that's the case. If you look long term, which is 2 years, and there is no question in my mind, it is unbelievable uptrend still in place. Now, there is no guarantee that it will continue. However, at this point, there is no evidence based on technical analysis that it will be any different in near future. And that's something that I definitely keep in mind when I make my investment decisions. Thank you very much.